Hello students and welcome to this explanation on general loans. I have uploaded for you a summary on general loans where I talk about the 3 steps as I explain them in the slides as well. But I've just made a summary and then some additional important notes that you may find useful when you are busy calculating borrow cost. So when we calculate general loans, there are 3 steps that need to be followed. In the first step, we need to calculate the average interest rate, and there you have to mind the months. So you need to look at the months within the first financial year for which a loan exists. So if you have received a loan on 1 July 2017, for example, and you have to do calculations ending 31st December 2017, you will adapt the loan amount for 6 months. So you will say the loan total, for example, 2 million rand times 6 out of 12. That's very important. And I have made a summary on the next page that relates to this. Then in step 2, you need to calculate the average interest in rand. And of course, these calculations are done in a specific sequence. And that's why I've set out these 3 steps. So to calculate the average interest in rand, you need the average rate which you calculated in step 1. And here I've said that you need to use a table and a timeline, which I will explain just now. And then we have step 3. I've noticed that in step 3, students do not struggle too much because this is the calculation of actual interest that you've always done since even you were in school. And here it's just a normal interest calculation at the actual rate for which the loan is obtained. All right, so please note that the average rate is not used in step 3. If we look at the second page of the summary that I've made, I started with step 1 and I spoke about the average interest rate, and I've just used some alphabet letters to demonstrate the calculation that needs to be done. So you have loan 1 and loan 2, and I called them X and Y. And X and Y needs to be adjusted for the months within that financial year. And please remember that an average interest rate needs to be calculated for the following financial year as well. So you will have a first financial year for which your calculation needs to be done. And then for the financial years to follow, you also need to do an additional calculation. You cannot just calculate the average rate once. The average rate will be recalculated at the beginning of every financial year. Should you now adjust it with the remaining months in the year, I call it C and D, and the sum of C and D gives you F. In order to calculate the average rate, you will need the loan rate given, and I call this A and B percent, but this is given in the question, so I need to state to you what the loan rate is. So in order to get your average rate, you're going to say C divided by F times A. And in order to get to the average rate of Y, you're going to take the D divided by F times B. And the calculations that you've done here, you will get the sum total, as I've indicated in red, and add them up, which will then be known as the average rate. After you've calculated your average rate, you will then calculate your average interest in rand. Here you need a date interval for which you need a timeline. I will be discussing the timeline just now. You need an opening balance and a progress payment. The opening balance and progress payment is added together, and then this total is used for the interest. So you will say interest amount is J times the average rate which you calculated in red times the months within this interval, and that will give you the interest, and then you will have your closing total, which is equal to this total. The closing balance will, however, include the interest that you've calculated here, should the interest not be paid for as the time progresses. If interest is also paid at some point in the future and it's not paid in regular intervals, then it needs to be added to the closing balance. But you will find that in majority of questions, they do indicate to you that interest is paid for as the interest is incurred, because that assists us in maintaining the loan agreements as they are. Then in terms of the timeline is quite important for general loans, and you will also use the same timeline when you are calculating your interest earned. For the timeline, you need to dot the following. You need to dot the date on which your loan is received, the date of progress payments, and then the date of year ends. These three things need to be jotted onto your timeline in order to be able to identify the date intervals that are used under this heading for step 2. Right, to calculate interest earned, I've also made a summary. And I have indicated here that you need to use the rate that is given. So normally in questions, they give you a 2%, a 3%, a 5% interest earned. And two things are required to do your interest earned or to calculate your interest earned. I like to use a table layout. And again, you need your timeline. So this would be the same timeline that you drafted for your general loan. To calculate the interest earned, the following is done in table format. I use the date interval, the loan. In this instance, you will find that the progress payment is minused to get to a total. And then the total, which I represented by V, I take V times the rate given times the months within this time interval. Again, for the timeline, you need to jot the date when the loan is received, when the progress payments are done, and the date of year end. I have made a note here to say, please remember that interest earned cannot be calculated on an overdraft, because an overdraft is a facility that allows you to withdraw more money out of the bank account than you have, but it's not a sum of money that you can withdraw and put into a savings account in order to earn interest. That would only be things like general loans that can be used for that. Then in the final note, I also said that interest earned is deducted against the historical cost during the capitalization period. So please remember, if there is an instance where interest is earned, you need to go and look at your capitalization period. And during the capitalization period, this interest earned is not recorded as income. It is recorded as a deduction against the cost price of the asset that you are constructing in terms of this borrow cost. The question that I want us to look at is called Textile. And Textile says that this is a business. Textile trailers were incorporated in June 2008, and they started trading on 1 July 2008 with a financial year end of 30 June. The company applies the International Financial Reporting Standards, as all of us do. Textile mainly manufactures and sells trailers to South African residents. The trailer sales were doing extremely well during the past 2 years, but directors still felt that they can perform much better. So during the 2017 financial year, the directors also started to buy and sell trailer parts. Textile rented the premises in the industrial area of Annabelle Park until the owner of the premises sold the property at the end of December 2013. The new owners of the premises allowed Textile to continue renting on a monthly basis. This made the directors of Textile realize that it was time to own their own property, the most important reason being that it would then be their property to do with as they see fit, and that it will also be an investment in the future of this company. Textile continued with the month-to-month lease until the day that their own premises was ready for occupation. They have, in the next bit of information, they provide you with the accounting policy, which is very, very important. And it says, firstly, for PPE, land is not depreciated. And we use the revaluation model, the net replacement value, and we eliminate the accumulated depreciation. For buildings, it is stated that they are depreciated over their expected useful lives, taking into account the residual values. Again, the revaluation model is applied. And we have a net replacement value where the accumulated depreciation is eliminated. No changes in useful lives or estimated residual values took place during the financial year. And then for investment property, they say in terms of IAS 40, we apply the fair value model. And for intangible assets, which are things like your licenses, your websites, which are becoming increasingly popular with online sales. They say in terms of their intangible assets, they use the cost model in terms of IAS 38, which is the standard which regulates intangible assets. In the first note, they talk about land and buildings, and they say Textile was very fortunate to find the most ideal property. The property is close to ArcelorMittal, the main supplier of steel for manufacturing the trailers. It is also located in the industrial area of Annabelle Park, close to the old premises, and therefore clients would not have problems finding the new premises. Over the past years of trading, Textile has accumulated funds for expansion purposes, and then they used these funds to buy a piece of land on 1 January 2015 with a cost of 942,000 Rand, and this full amount was paid for in cash through electronic transfer. Due to cash shortages for erecting the building, Textile negotiated with SAAB Bank. The bank offered the following funding. We have a bank overdraft that is worth 1.2 million Rand and an annual interest rate of 8%, and then a general loan which is worth 400,000 Rand at an interest rate of 12% per year. Then the next sentence is very important, and so important that I highlighted for you in yellow. It says, interest is paid for as incurred. So this means that we do not capitalize the interest. The interest is paid for as we go along, so we don't have to calculate interest on interest. Then it says both types of funding would be obtained on 31st of March 2015. In the next sentence, we are told that any excess funds are invested in a savings account. Simple interest is earned at an annual rate of 3%. Then they've also given you a summary of your progress payments. You would find that 2 of the payments were made during 2015, and then 3 of them during 2016. On your right-hand side, they've given you the amounts paid and the total. You can see that the total does add up to the funding that we've asked for. And they've given a description of the progress or the reason why the progress payment was due. They say it was decided that the full bank overdraft will first be exhausted before the general loan is used to make progress payments. So we must first eat up, if you think about Pac-Man, we must first eat up all the 1.2 million overdraft, and then we will get to the general loan, which is worth 400,000 Rand. They say the building was certified as complete and ready for use on 1 May 2016. So this is very important information. This is the date for which our capitalization will end. When will the capitalization begin? Well, they say that the capitalization should begin on the date that payment is first made towards constructing this asset. So that would be 1 April 2015 when the first payment was made with the intention of constructing the asset. They tell you that it is estimated by the financial director that the building will be depreciated over 30 years, and it has a 560,000 Rand residual value. In this instance, the residual value will be deducted because this building is considered PPE. Then they say on 30 June 2016, a company called Van Staden Revaluators performed a valuation on the above mentioned building and found that the net replacement value is 182,000,000. In the required part, they ask you indicate the journal entries that should be posted in order to account for the general loans for the years ended 30 June 2015 and 30 June 2016. So we need to do calculations for 2 years. Right, so I've already just started my layout in terms of my step 1 and step 2, because I have now provided the summary of how it should be done, step 1 and step 2. So I basically use this information to construct a memo so long. Right, if we look at step number 1, we need to calculate our average rate. The average rate is calculated for both financial years. So as I've stated, you need to calculate an average rate for every financial year. The bank overdraft, I believe, is worth 1.2 million Rand. However, we need to adjust it for the months in the year. Going back to the question, it tells us that the loans were obtained on 31st of March 2015. So there was March, then it was April, May, and June. So the loans existed for 3 months within that financial year. And that gives us 300,000. The same will be done to the general loan because the total general loan is worth 400,000, but it is received on the same date as the bank overdraft is approved. So it's 3 months within that year. The rates are given for the different types of funding. I believe that the interest rate is 8% for the overdraft and it is 12% for the general loan. I want to get to the total of the loan amount. If my mathematics isn't too poor, there should be 400,000. And now to get to my average rate, I'm basically going to use the loan amount that I've calculated as a fraction. So I'm going to take the 300,000 divided by the total of 400,000 and I'm going to times it by the 8. Please note how I only times it by 8. I've seen some students bugger up this calculation because they type into their calculator times 8%. You should only type in whatever is before the percentage sign on your calculator. Please take note of that mathematical boo-boo that can happen. So essentially, I'm just going to say times 8, not 8%. Although the answer is expressed in percent, that's not something that I would type into my calculator. Then for the general loan, it is 100,000 divided by 400,000, and I'm going to times it by the 12, and that gives us 3. 6 and 3 should give us 9% interest, or average interest. For the second year that calculations are required, the bank overdraft amount would not be adjusted for a number of months because it exists for the full year ending 30 June 2016. So it's going to be 1.2 million times 12 out of 12, and it's going to be 400,000, which is the general loan, times 12 out of 12. Then the rates are still 8% and 12%, and then this should add up to 1.6 million. And I will now calculate my average rate again by factoring or using the loan amount as a fraction of the total times the 8. And 400,000 divided by the total times the 12. Again, we get to a total of 9%. Please note that the answer being 9% in both instances, it is purely luck. It does not often happen. So don't assume that if you've calculated the average rate once, the answer will always be the same for every financial year that follows, because it's not necessarily true. Actually, more than not, you don't get the same average rate for both years. So you have to recalculate it. It's purely by accident that these two are the same in this question. Right, then we are moving on to step number 2 for general loans. And that is that we need to go and calculate our average interest. So the average interest is calculated then at 9%, which is the average interest rate. But we first need to go and find our time intervals or draft our time intervals for which we will be doing our calculations. So for that, I like to draw up a timeline. This might take an extra 5 minutes, but I would always spend an extra 5 minutes to do a calculation, then make a mistake, and then at the end of the test having to go back and recalculate everything and fix all my answers. That is just so emotionally draining. So I just spend an extra 5 minutes so that I know my answers are wrong and I do not have to worry. So for the timeline, please excuse, I am by no means an artist. So I'm just opening a paint page here. And suppose this is now our timeline. So you will remember that I said on the timeline there are 3 things that we need to indicate. We need to indicate the date that the loan is received, the date of progress payments or the dates of progress payments, and then the date of year end. If I look at the first date, which will be the date on which we receive the loans, that would be the 31st of March, and that is 2015, I believe. Right, then the first progress payment is made on the 1st of April. So I'm just going to put it on top of this line because 31st of March and 1 April is 1 day apart, and we don't account for 1 day in accounting. So this will be 1 April 2015, and that was the date on which we made our first progress payment. So I'm just going to continue with the progress payments. The second progress payment was in August, so that would have been about April, May, June, July, August. So I would draw it here, and it is done on the 1st of August 2015. Then there is one in February, so it's going to be August, September, October, November, December, January, February. So let's put it about there. On the 1st of Feb 2016. Then there is one on 1 March, so it should be about there. 1 March 2016. Then we have in May, so I'm going to put May about there. Let's write it here. 1 May 2016. Right, so that was all our progress payments. Then the last thing we need to do is put in our year ends. Right, so for the year ends, it would be June. So June would be somewhere around, let's say, there. And that would be 30 June 2015. And here we would have 30 June, and that would be 2016. In this instance, we can now clearly see our date intervals that we need to use. The first interval will be between 1 April and 30 June. Then the second one will be between 30 June and 1 August. Then the other interval will be between 1 August and 1 February. Then the other one, or the, second last one would be between, let's just make it another color, will be between 1 February and 1 March. Then we will have 1 March to 1 May. And then the final one will be between 1 May and the year end, which is 30 June. So here we can now clearly see all the intervals that are required. And you will see I've jotted them down here. So 1 April to 30 June to 1 August to 1 February. So this is where I found my intervals on this timeline. If you draft this timeline, you will also use it to calculate your interest earned. Moving along, we need to start with the opening balance, and the opening balance for your interest that you are going to pay is always 0. And then the first progress payment is made on 1 April. So I always have this question, ma'am, when do I know I should put in the progress payment? The progress payment is put under the slot where your interval, your date interval starts with that date on which the progress payment is made. So you will see this interval starts with 1 April and the first progress payment is made on 1 April. So I'm going to put in the 200,000 here. Total 0 plus 200 should give you 200,000. Then we have our interest at the average rate. So it's going to be the 200,000 times the 9% that we calculated as average times the months in the date interval. So it is April, May, and June. I get 3 months. The closing balance is going to be 200,000 because they tell us in the question, as I've highlighted, interest is paid for as incurred. Should interest not be paid for as incurred, this total will be 204,500. Then the closing balance is the opening balance. There is no progress payment on 30 June, so progress payment will be 0. And that leaves us with another 200,000 Rand total. And we're going to say 200,000 times 9% times the dates, the months in the date interval, which is July. June we're not going to count because it's the last day. And August we're not going to count, it's the first day. So it is 1 out of 12. And then our closing balance will again be 200,000. There might be students who would want to ask me, why didn't I just calculate for 4 months in this interval? And that is because of the accrual concept. The accrual concept says we need to account for 12 months. And our year end is 30 June. So I split this into 3 months, 1 month, so that I know, should one ask me, what is the interest expense for the year ended 30 June, then I can just know the average interest is 4,500. Had I done the whole calculation, I would have had to do a split between the 4 months. So it just makes my calculation easier. Then is there a progress payment on the 1st of August? Because this interval begins on 1 August. There is. That progress payment is 300,000. And that leaves me with a 500,000 Rand total. I'm going to take the 500,000, times it by my average rate of 9%, times it by the months in the interval. So that should be August, September, October, November, December, and January. I do not count February because it's the 1st of February, and we don't account for 1 day in accounting. Closing balance, 500,000. Closing balance becomes opening balance. Then, is there a progress payment on the 1st of February? Because this interval starts with 1st of February. There indeed is. It's an 800 Rand progress payment. If my mathematics isn't too poor, there should be 1.3 million. And I'm going to take the 1.3 million times 9% times the interval months. So this is February. March, we're not going to count because it's the 1st of March, so it's 1 out of 12. 1.3 million, the closing balance is the opening balance. Then, is there a progress payment on the 1st of March? There is 150,000 Rand progress payment, which should give us 1,450,000. And again, I'm going to say this times the average rate in 2016 times the months in the interval. So it's March and April. May I'm not going to count because it is the 1st of May. Closing balance is equal to the total, and the closing balance becomes the opening balance. Is there a progress payment on the 1st of May? There is a progress payment of 150,000 Rand as well. And this now should be 1.6 million. I'm going to take the 1.6 million, times it by my 9%, times it by the months in the interval, which is May and June, 2 months. And there I have completed the calculations as they are now required for my step 2. Right, for step 3, we need to go and calculate our actual interest. So for actual interest, I'm going to say that I have a bank overdraft and a general loan, and I now need to apply the actual interest rates and the months for which these loans existed in 2015. In this instance, I'm going to say it's 1.2 million for 2015 times the actual rate of 8% times the months, 3 out of 12. That should give you a total of 24,000 Rand. For the general loan, it's 400,000 times the actual rate of 12% times the 3 months for which the loan existed in 2015. That is 12,000. And that is a total of 36,000, I think. During 2016, these loans existed, or these fundings existed throughout the entire year. So it's going to be 1.2 million times the 8% times 12 out of 12. And the general loan will be 400,000 times 12% times 12 out of 12. That calculation should give you 96,000 and 48,000, and the sum of that is 144,000. I hope. Let's just check. Yes, 144,000. Right, so there we've completed our 3 steps for general loans. What is left is we still have to now do a calculation for our interest that is earned at 3%. So you will find they tell you that interest is earned at 3%, and it's a simple interest rate. So if I go back to the summary, we need a table. I'm going to put in the table to do my calculations, and we have already drafted the intervals on our timeline, so this shouldn't be too hard. What I am going to do is I'm basically going to take the table that I've used for step 2, and I'm going to use it for my interest earned, but I'm going to change it slightly. So the date intervals will remain the same. Instead of opening, I'm just going to say loan received. Progress payments will remain. Then I will have a total. And I will not need an average rate, but the given rate of 3%. And closing we can have or we cannot have. I don't think that this is essential. So for the loan received, there's something very important that we need to take into account when we do the interest earned. And that is that the bank overdraft that we have cannot be used to earn interest. It's only the general loan that can be used to earn interest. And this general loan we get on 1 April. So I'm going to put it in loan received 400,000 Rand. Right, so now something that's also very important to take into account is the sentence where they tell you it is decided that the full bank overdraft will first be exhausted before the general loan is used to make progress payments. So the general loan, if we count back now, the general loan, for the general loan, it's a total of 400,000, and that is the funding that we will use lastly because the bank overdraft is first exhausted. So I'm going to count from the bottom. And we will use our general loan to cover this 150,000. And we're going to use our general loan to cover this 150,000. And then it's 300,000, but the general loan is 400,000. So we're also going to cover 100,000 here for our general loan. So 700,000 of this 800,000 will be the bank overdraft, and the remaining 100,000 that we will need will then be for the general loan. So I'm going to say we basically split it. So it is 700,000 will equal the bank overdraft. 100,000 will equal the general loan. So that I'm going to make yellow as well. So we need to start paying attention to the date as well. The general loan will then only first be utilized on the 1st of February 2016. Going back to my calculations then, I'm going to say there is no progress payment for the 1 April interval, for 30 June, for August, but the progress payment will only come into play on 1 February. And for that progress payment, we need 100,000 of the general loan. So that's going to be minus 100,000. Then this 150,000 will be paid for by the general loan, and the last 150,000 will be paid for in the general loan. So my calculations will then be the total for the first interval is 400,000. And again, I do the first interval separately to accommodate the financial year. Should someone ask me, but what is the interest that is earned for the year ended 30 June 2015? I can immediately read it from my table. So it's going to be the 400,000 times the interest rate that interest is earned for. That's given as 3%. So this is this 3% given. And then I'm going to times it by the months in the interval. April, May, and June, it's 3 months. Right, now I've typed it in the wrong one. The total should be equal to the 400,000. Interest rate should be 400,000 times by my rate times by the 3 months. Closing will then be 400,000, which leaves this an opening to be 400,000. So as these two are still in the same financial year, and for both intervals there is no progress payment, you can skip over and just add all the months for these two intervals together, just to save a bit of time in your calculation. But the intervals will still help you to count the months. So here I'm going to say the total is 400,000, and of course here the total is also 400,000. But here I'm now going to say the interest is then 400,000 times the 3%. And now I'm going to count the months from 30 June up till 1 February. So it is this June, so then it's July, and that's 1 month in that interval. Then from 1 August, this is then 1 month. Let me just make sure that you understand where I get this from. So this is 1 month, and then August, September, October, November, December, and January, February I'm not counting, is 6 months. So yeah, I'm straight going to say it's 400,000 times 3% times both the intervals, which is 7 out of 12. That's 7,000, and here we still have 400,000 left. So for this interest earned, I just put these two together because they are in the same financial year. Then for the first payment that will come from my general loan, I'm going to say 400,000. Please note how the progress payments are now minused with interest or interest paid. Progress payments are added. So 400 minus 100 gives us 300,000. So that will be interest earned on 300,000 Rand times 3% times the interval period here, and that's 1 month. Righty, then we are on the 300,000 here, minus 150,000 is 150,000 left. So it's going to be the 150 times the 3% times the months in this interval, which is March and April. May I'm not going to add because it's the 1st of May. Then this 150 will be carried over because that is the loan amount. We minus it, there's 0, so there will be no interest that can be calculated. Right, so there we have now also calculated our interest earned, and this is all the calculations that will be necessary in order for us to be able to do the general loans in this question. So this is a lot of calculations, and then we haven't even started with the required part. So I'm just going to stop the video here, and then in part 2, I'm going to show you the journal entries as they relate to these calculations.